My name is John Keppel, partner and head of the private group at a law firm called Lips Mathias. I've decided everybody here today gets a free deal because we all dealt with the fun experience of the UN and Biden, everybody in town. So I'm thrilled to be here today. I'm a deal lawyer, work with a lot of great independent sponsors, a little bit of private equity. And so happy to chat with you guys. You have questions later today about structuring deals, putting partnerships together. We've got an amazing panel here today. The first couple of panels kind of covered, how do you get started? How do you find the deal? How do you put them together? We've now closed a deal, this imaginary panel, right? And we've got an amazing panel here that we're going to talk about that first 30, 60, 90 days, what went right, what went wrong, war stories. So it should be really, really fun. So I'm looking forward to it. So I'm going to turn over to my next here. Go ahead and introduce yourself.
Press it. There we go. Thanks, John. I don't know how fun talking about war stories is, but we'll see what we can do. I'm with a private equity firm called Black Lake Capital. We're in Denver, outside of Denver. We've closed 11 transactions since our founding in 2013, primarily in tech-enabled business services.
Bryce Winkle, Resurgent Capital Partners, based out of LA. We, unlike everyone else here, do deals between 1 and 5 million in EBITDA. We're operationally focused. We've done 4 deals and pretty much regular way independent sponsor. We're cheap and always looking for capital.
There we go. Hi, everyone. I'm Andrew Furwarn with Virtus. I co-lead our firm's private capital insurance practice and really work with independent sponsors, private equity firms, family offices, engaging with them pre-close on due diligence on the target's existing risk management and insurance programs, and then from there strategies to support close and ongoing value creation following close. On top of that, of course, transaction related work, so reps and warranties and liability insurance. And in from Chicago, excited to be here.
Hello, good morning. My name is Melanie Santos Grant. I'm the founder of Second Gen Partners, an independent sponsor. We're focused on business services and consumer brands. We signed up for this panel when we had 3 deals under LOI, and we were going to be in 60-day.
Green should be good.
Okay, so anyway, so one of our deals fell out, and so I'm in no man's land with 2 LOIs currently, but happy to talk about previous experiences pre-opening up this firm and post-value creation opportunities.
Hey, Pierce Edwards. I'm with Valesco Industries. I think I bring a unique perspective today. I was with an independent sponsor, kind of a junior guy for about 4 years. Joined Valesco. We are an equity-oriented capital provider, back an independent sponsor. So I've seen both sides of the fence. My perspectives have changed and evolved, and know how to play nice in the sandbox. I know how kind of to achieve a partnership and achieve a common goal. And I think that's been really interesting to see over the course of my career. We're raising our 3rd fund right now. We typically lead with equity, which is a common kind of solve for in every sponsor deal. So excited to talk through our objectives today.
That's awesome. Thanks, everybody. Forgot to tell you, so if you see me later today, 2 things. Happy to talk about structuring deals. Also from Buffalo, huge Bills fan, Josh Allen. So any Bills fans in the room, we're going to talk about the #1 team in the league. Happy to chat about that as well. Sorry. So we've got a great panel. I'm just going to kind of toss these up for air balls. People can kind of chime in. So we've closed the deal. When you sit down day after closing, in your mind, what's the #1 thing you're thinking, we've got to accomplish this in the next 30, 60, 90 days? What's that key driver that immediately comes to mind?
I guess from my perspective, we really focus on people in all of our businesses. We do services businesses, but my feeling is that all businesses are people businesses. And what can we do to make sure we hang on to all our people, that they're kind of motivated and on board for whatever value creation plan we have in mind? Really can't kind of do KPIs and that sort of stuff until you're sure you got the team on board. So that's kind of our first area of focus.
Yeah, I think along with that, sort of in the first 30, 60 days, people are more willing to accept change than they were the day before that, or they will be once you settle in. So if there's something you want to do, and it's going to be painful on the people side. Make sure you do it early while people are still open to the change. Beyond that, it gets a lot harder to do things, but people are still in a bit of a state of shock, and you can actually make real big progress very quick. I mean, it seems mean to say, but the reality is when people are a little bit nervous, they will follow your vision much better than once they've settled into a pattern and realize nothing's going to change or anything like that. So if you do have one big thing you want to do it in those first 30, 60 days when you still have sort of that confusion that people will go along with you, and they'll settle in after that.
From a service provider perspective, I think it's, there's such a heavy lift to get the reps and warranties in place and other insurance coverages in place at close, that we try to really bow out, I think, in those 30 to 90 days following, unless there's been some other agreed upon strategy. Because typically, obviously, there's a lot more bandwidth to execute some value creation strategies with the insurance programs on a longer term time horizon. So that's a way that we try to support both the management team and of course the sponsor.
So we focus on alignment. I think Chris was focused on the people, and I think the alignment with the vision and how their contributions actually make that come to happen is what we focus on. And so a lot of times during diligence, we'll go through some of the value creation in diligence, and we're actually executing, setting up management meetings and things around those ideas that came out during diligence.
We start with the end and work backwards. So everyone in this room is interested in carry. We all know we have to double the business to achieve our objectives as capital partners and as independent sponsors, right? So we start with that in mind and say, hey, how can we double this business? What are the steps to get there? And then when we talk to our independent sponsor partners, it's what lane do you want to run, and what is your objective as we move forward? We've worked with a few folks in this room. One recent one was, all right, you're going to transition the founder out. You build a relationship with the founder. He's 60 something years old. Chris, right in front of me, it's his group. He's been 60 for like 10 years. But we right away said, all right, you guys build a relationship with this business owner, and you have a lot of relationships with CEOs and management teams that know this space. That's your lane for the first 30, 60 days. Let's go find more talent to bring into this C-suite. Then for us, oftentimes the finance component is lacking. So let's go get a CFO. Let's get our reporting dialed in. Let's make sure our bank partner's happy. Let's make this a replicable business model that we can grow and then subsequently double.
So those are all great goals. Now let's flip it to kind of a Monday morning quarterback type of question, right? So I'm sure you all have war stories from you've closed deals and you look back and say, what went right, what went wrong? I hear from a lot of independent sponsors that, the dynamic with, the management team, with the founder who may or may not be staying in the business and that role and all the tension there. So what if you look back on some of the deals you guys have closed, nobody's perfect, right? We're all human. What are things that looking back, you know what, this deal, that was a problem. I wish I had done this sooner. I wish I had changed this. So.
Yeah, I think made a lot of mistakes, but the one that really sticks out is when you don't make sure you've got a relationship deeper than just the founder. I think you have an issue when you buy a business that you're sitting across the table from a majority owner and trying to structure a deal, and you kind of forget about the folks downstream. And it is hard to make that transition from somebody who's been in control of 100% of every decision and kind of get read in on things as they happen. It's much more helpful if you can kind of have a relationship, not just through one person, but through other folks. So as you try to install things like metrics and goals, and that may not have been there historically, you're not just kind of pushing it towards a founder who feels like he's sort of done everything perfectly from the get-go. You've got some buy-in from the rest of the group, and if you do it right, which we have about a 50% success rate, you can make it so it's kind of his idea instead of yours, and that's where you really win.
So yeah, I think one's a funny anecdote since you asked for war stories. One is check the founder's firearm policy. It turned out we had a guy who had a .357 in his desk drawer loose, and everyone knew he had it there, and they were a little afraid of him. So check on that first. But beyond that, I think it's sort of circling back to the capital provider relationship is actually investing the time. You get so focused on, we just bought the company, got to get on site, got to start meeting the people, get deeper in the organization, all that. But bringing the capital provider along, because they are very thinly staffed. They often don't have, you're thinking about 24/7. You're one of 10 of their portfolio companies, and being proactive, because inevitably you don't know what you bought until that first day, right? You find out things are perhaps different than you thought. And all of this, but you don't always bring the capital provider along. So then a month later at the first MOR, the first board meeting, oh yeah, we learned we're going to go do this now because some fact on the ground changed. I think investing in that open communication early and building that relationship makes a huge difference. As you learn things that are different than maybe you thought in diligence, that will provide the flexibility and air cover to have them along with you and not be surprised and kind of mad at you. And then you're fighting on two fronts. You're fighting the company and your capital provider.
Yep, and then it makes me think of, we engaged with a fund recently, and they had us due diligence across their portfolio, so 7 different companies. So of course, their close dates, ran the gamut, but really a lot of low-hanging fruit, right? So I was quick to say, I think, in the first 30 to 90 days, we try to, take our place and maybe fall back in line a little bit in terms of priorities, but there's a lot of low-hanging fruit there, and particularly in the lower middle market, which is an area that we focus on. You get businesses that are, evolving at a rapid clip. They're making add-ons, or there's significant organic growth, and the opportunities and risks that are involved from an insurance perspective. I mean, in a simple way, since everyone's familiar with health insurance and in terms of likely having it themselves. You get groups under 50 employees, and certain size segment with health insurance companies that, again, affords certain risks and opportunities, but then crossing into 50 to 99 and then 100 plus where, their claims experience weighs in. We've seen situations where the employer's cost has risen, in this example, it's a $10 million EBITDA firm, has risen from $250,000 to $750,000 without the fund's awareness of it, and really no proactive ability to dictate or say what they would like to do in that situation. So we've come in kind of maybe like in that situation, a post-renewal situation, and engaged and then worked to proactively avoid a repeat scenario at the next renewal.
I think post-close or just during closing, its founder transition has been very challenging because I think the expectations going into the process and then what the process looks like, and then making it through the deal process and then having to drive to get the second bite of the apple is more like a marathon than a sprint. And the founders generally have a different expectation. So we've been trying to learn how to manage founder expectations through this process.
Nobody likes surprises. So Bryce, you said it well. We've changed our objectives. We like to go monthly right away. And for the first, call it 90 days at least, that tends to go into 6 months. And then it's getting the right people in the right seats. You can typically assess that early, but the original question was what's gone wrong? And it's waiting too long, and it's not showing up right away and assessing that and saying, all right, I'll check in next quarter and we're gonna be the passive equity guy that shows up, and that's not the right way to do things. So we try to be much more proactive up front and then collaborate with our independent sponsor partners on, hey, I think we're both seeing that we need a new CFO. 5 years from now, when we sell this company, Tim in sales is not going to be the best guy for us to go national with this thing, because again, we have to double. So who's the best guy, and let's do this early.
Great feedback. So let's switch forward looking to sort of growth in sales. Obviously, you're buying these companies with a focus on growing the revenue, growing the sales. Many of these being family-owned businesses where you typically will ask them, how do you grow revenue? And then they say, well, we get an email, the phone rings, but how do you practically get leads? What's your internal sales strategy? What's your external outreach? And many of them just haven't really built that out yet, which can be a potential great opportunity. So I guess kind of a two-part question for the group here. You can answer one or both. Is when you look at organic sales, what do you look at? You try to hire a really key, awesome internal salesperson or persons? Do you look to bring in a lead gen team externally? And then alternatively is, and I get asked this question a lot, is when is too early for that first add-on? How long do you want to own that company before you've built in the systems and you're ready to do it? I've seen a lot of clients who they're only a few months in the gate and they get that phone call for that perfect add-on, and there's that tension of, we're not really ready to adjust it yet, but if we wait, we might miss this opportunity, and this could be a perfect opportunity. So organic growth strategies, and any thoughts on when is too early for a potential add-on? So
good questions. I think it depends. But our view, I think, on the organic sales side is, let's kind of figure out what we got. We tend to have businesses that don't have great systems. You don't know where they're doing well, where they're not. Obviously, the hardest thing for a small business is to get that foot in the door and to get that initial relationship, to get that MSA or what have you. So let's do the easy part first. I think focus on that internal sales, inside salesperson. They tend to be cheaper. And then, when we go to that kind of, let's develop some new logos and get out there and spread the word, that's a harder sale. So I think we tend to kind of get our house in order first, and then pick that person up who tends to be pretty expensive. The one word of caution I would give is we oftentimes, like when we look for that salesperson, we end up with this guy. Hey, he was great. He was at Accenture. He ran a $25 million business or a $50 million business. Well, it turns out he also had 58 guys working for him and he can't do anything. So you got to find a person who's pretty hungry, who's used to like actually picking up the phone and doing the work, which is a pitfall that maybe I should have mentioned on the not to do thing. And I guess I've talked long enough on that one, so I'll kick it down. Somebody else can answer the second question.
I guess I would kind of echo the thoughts. I think as independent sponsors, we don't necessarily get the same leash with the J curve in terms of we can burn money. I mean, you're basically, your covenants are going to be always upward and higher up and to the right. And so, I think what we do is as soon as we can afford from a cost neutral basis to start layering on new cost is when we do it. And that's really, you got to find whatever savings you thought you were going to find initially, get those going, and your capital provider will be a lot happier with you when you do make those experiments. And I think always go in with the idea that this is a time-bounded experiment. If we don't have X amount of traction by Y date, we're either cutting bait on this strategy or on this person. And you need to use that time to sort out, is it the strategy or is it the person? And you tell the capital provider and the board and everybody, this is a $50,000 investment. We're going to take a $100,000 a year person. We're going to run them for 6 months. If they fail, we'll know and we will take action, but you got to be ready to pull that trigger and a little bit ruthless about that. As far as add-ons, I'll let someone else answer that.
So as an independent sponsor, I think creativity is what we bring to the table most of the time since we're working with capital providers. And so we look for creative solutions in organic growth. And then if there are add-ons that are missing infrastructure or certain components that we can add on right away, we would do that because it's easier to continue to adapt to change if things are changing. And so an add-on is a great way to show things are changing.
We focus on organic growth first and foremost, and then lately have been implementing more of a digital strategy. How can we make our marketing look better? What does our website look like? Oftentimes it's not great. Let's ramp this thing up, make it look like we're a real company here and get better marketing materials. So those are kind of the first two things we do.
That's great feedback. And the other, I didn't ask this question to the panel. The other tension you sometimes see with these size deals is sometimes you find that first opportunity in the segment, but it's a little smaller than you'd like it to be. And then how do you, we have a client we're working with now who's going to finance that initial deal with all equity. It's only $1 million EBITDA business, but it's in a nice sector. They think there's some opportunities for bolt-on. So maybe one strategy is close that first one all equity. Then when you're ready to do that add-on, you can put some down in the combined business. So let's switch over and talk about kind of the management teams and sort of the incentive plans, right? Obviously, there's a variety of options from stock options, profits interest in LLC, cash bonus plans. What are some of the things, panel, you think about in terms of how do you design them? Do you try to get them in place, pre-close, at close? Do you say, you know what, other than maybe the CEO, let's wait 90 days and then we'll kind of get a sense of the team and how we're going to design this plan. So what do you think about in terms of these plans, equity, cash components? What are some high level thoughts?
Yeah, it's a good question. I would say best practice is before close. Reality is typically after close. Just got a lot of balls in the air trying to figure out. But one of the things we really go after early is to try to drive some ownership deep in the organization. So we'll do like a phantom equity plan that is for some portion, 2 or 3% of the company. So pretty much everybody can call themselves an owner, has a piece of the business. I think that's really important, and we try to get that in the first 30 days. Make sure that you've got out there, and it's something you can sell as, hey, life is getting better under the new ownership. You are now owners too. And I think the other, sort of pitfall we've fallen into is getting too cute about, sort of structuring those incentive plans. Like, I really want you to sell a new logo and I want you to have a gross margin target. So you've got like a gross margin accelerator and it's a new business. So you get 8% of sales instead of 4%, and nobody has any idea what they're doing. So I feel like we're really focused, like 50% is overall company EBITDA performance. 50% is one metric that's just like a straight line that we want you to focus on, sales growth or gross margin or whatever, but trying to really simplify that plan so everybody kind of gets it. And of course, you're going to miss on some of the nuance, but I feel like just fast and easy is better than perfect and hard to understand.
So interestingly, I'm going to actually disagree with a fair bit of what he said because he's wrong. I think the idea of going deep with small tastes of equity to everyone in the company sounds really good, and the idea of telling people they're owners actually is a good morale thing. But what we found is that people really actually undervalue equity, small tastes of equity that's long in duration, and really overvalue near-term cash, which is the exact opposite of what we as sponsors value, right? And so I don't want to say it's an arbitrage, but it doesn't drive behavior. It does in the very short term because people feel good. But we've noticed actually we've given away equity and then it's kind of meaningless to the people, and they're back asking for more cash the next week because they have some, their kids going to private school or whatever it is. And so we started with that model, and we've kind of pivoted more towards cash incentives that are aligned with the business goals. Because we just find that people are more coin operated than they even necessarily perceive. But as far as very tight objectives that aren't, salespeople in particular, and frankly, any employee is super creative. So if you set complicated metrics, they will only manage to those, and they'll completely game it, and you won't even see it coming, and you won't think through that eventuality. So simple, focused, aligned with the overarching business goal generally.
Yep. And then when I think of growth, it gets me thinking of executive benefits, and then also the fact that a lot of these businesses have outgrown their existing programs. So we try to come to the table with strategies and some options, and really move the needle on some things that really aren't a drastic change in spend to drive more value in the existing plans. So it's kind of one angle. And then, of course, working with the CFOs and HR folks to get their take on the existing programs and where there's any perceived weaknesses from their employee population to help support whatever the growth mandate is moving forward.
Yeah, so I'll agree with the cash incentives aligned with profitable sales seems to be a good way to get everyone focused on what matters in the short term. And then being able to identify the drivers to do that. Because giving away the equity seems like a great idea, but it doesn't render the behaviors in the short term.
So we do profits interest pools, and we do not allocate them till after year one. I think that's been a good thing for us to do, because oftentimes you just play this thing out for a year. 12 months later, you're like I said earlier, this isn't the right person for the doubling of the business. Let's unallocate these, see who's good, and then use these as a piece of bait to attract someone great to come in and help work with us. But oftentimes, pre-close, maybe there's a couple of key management folks that we want to allocate and make sure they're vested, but a lot of it we try to leave unallocated for 12 months.
That's a great point. We've got about 5 minutes left. We may try to take an audience question or two, so start thinking about that now. I think the only thing I would add as a deal lawyer on stock options and profit share plans is, over the course of my career, I find they're getting more and more creative, and maybe complex is maybe not the right word, but for instance, it used to be historically just time-based vesting, right? Now more and more private equity sponsors going to either half time-based, half performance-based, sometimes even all performance-based, sometimes tying it to a return on, hey, you're going to get, 5 profits and points, Mr. or Mrs. CEO, half that's time-based, half that's performance-based. And it's that performance might be even tiered, so if we get, 2x on our capital, you get that extra point vested. If we get 3x, et cetera. So we just, on the flip side, just work with a CEO, new CEO who was heavily recruited to join the education platform. He can ultimately get up to 7 profit points. Now there's some pretty significant tiers he's got to get through to get to that point, but huge alignment of interest, right? I mean, at that point, most sponsors are looking at it. I'm almost happy to pay out those 7 points because we've gotten a 3 or 4x on our investment. So questions for the panel. We got a couple minutes last on post-close, things you want to know, you're curious about. Otherwise, I've got one more quick question I can toss up here, but any questions from the audience here? So I think the last thing I'll toss to the panel is, you hear a lot about individual sponsors buying business size. One key driver for future value is obviously revenue and EBITDA. The other key driver you hear a lot is professionalizing the business, right? That next larger PE firm, that next strategic, they're not going to roll up their sleeves and do all this dirty work. If you had to pick one thing and one thing only, what's the key? It could be a sort of software system, some sort of plan or policy. What's the one strategy you've done where you look back and say, wow, that really professionalized this particular business?
I'm going to piggyback on Pierce. I think that the digital sort of website, social media, all that stuff has been, I think, more valuable than audited financials. Everybody does audited financials, so I guess that's 1A. But I think the digital presence is a big deal. I say digital presence like website, social media, whatever. It's been a good place to invest.
Yeah, I think the obvious and common answer is CFO. And I think it helps with the capital providers. It helps with presentation of the next business. But picking one that actually isn't just a CFO, I think it's actually the who matters here, which is someone that's almost COO, CFO, because a lot of these businesses can't afford both. And so someone that can speak to the business, that doesn't have the wild-eyed founder, let's go tackle the world, but is clear-eyed, thoughtful, and can pull together professional presentations and present them in a stoic manner, I think is oftentimes lacking in these lower middle market businesses.
It was inevitable I'd have my turn to have a mic issue, I guess. Yeah, and when we step in often, it's kind of running the gamut of a hodgepodge of different insurance programs. So really our focus is to streamline, simplify, of course, drive better economics in the plan as well too. But simplification is a huge piece of it. And then using data, benchmarking and other sources to help support making decisions about any added programs or changes to the existing programs to the extent that they're needed.
So I think that digitalization is a good strategy. I think the other thing we focus on is governance, is being used to sharing in a thoughtful manner what is going on in the company and try to stop the firefighting as much as possible.
I would say the one thing, if I had to pick it, would be hiring the badass, overpaying for the right guy. Because I think we all get heartburn early to say, oh, we're gonna go back and forth over whatever the $50,000, $60,000 salary number might be. Oftentimes, recall these are not
The $500 a month car allowance, the last minute stuff that comes up. Yeah.
But these are companies not based in Manhattan, right? These are companies based in Middle Michigan, rural North Carolina. So how can we recruit someone that is a legitimate, talented person to come in and be an effector of change with us? So let's hire that person early. Let's pay them the right price, and let's have that person ride along with us for as long as possible. Something we've gotten accustomed to.
Great answer. Thank you all very much. Enjoy the rest of the day today.